All right, you're on Module 2, which is starting the balance sheet. Specifically, we're going to look at two of the three items on the balance sheet, the assets and liabilities. The Coursera content in this module is comprised of the same course you were looking at before, which is Financial Accounting Foundations from the University of Illinois, Urbana-Champaign, Professor Erkan. We're going to be looking at week 4, which is short-term assets, and then going right on to the second course in that sequence, which is Financial Accounting Advanced Topics. And that's also from the same professor university. And we'll be doing weeks 1 and 2, which are long-term assets and liabilities. This is actually a deeper dive into the assets and specifically the short-term assets. As you recall, the balance sheet has assets which are broken into classifications of current versus non-current. Short-term, also known as current assets, are those that are already cash or will be converted to cash or used up in 1 year. Anything over that, over 1 year, is long-term or non-current. We'll be focused on the current assets that we most often see, which are accounts receivable, which are simply amounts that your customers owe the company, and inventories, which are items you have that is for sale or will soon become available for sale. And both of these are essential in most businesses, and they're directly connected to the income statement. Our learning objectives are to do valuation of accounts receivable and the GAAP principles that are included, and appreciate how cash discounts, sales returns, and bad debts impact the valuation of accounts receivable and the income statement, by the way. And then differentiate between the different types of inventory often found in companies, and look at valuation and calculation of impairment of inventory. And finally, look at applying different cost flow assumptions and how they can impact the final balances in the cost of goods sold and in the ending inventory accounts. This material is in form of video, practice quizzes, and some reading, and the total estimated time for completion is about 2 hours. It's a fairly dense amount of material, so make sure you're awake for this one. The next one is long-term assets, which is, as you might imagine, the ones over 1 year in length. And this is the flip side of what we just saw in short-term assets. And these are often called capitalized. Capitalized is where we spend money, but instead of having it go to the income statement as an expense, it goes to the balance sheet and something we hold because it has longer value to us than simply 1 year. One of the examples is if I take a client to lunch, that's an expense, right? We ate our lunch and we're done. But if we bought a major manufacturing plant, that's an expenditure that will benefit us for many years to come. So when we capitalize things, that's when we make an expenditure and it's held on the balance sheet since it has longer term value. We'll look specifically at PP&E, property, plant, and equipment, and look at how it undergoes depreciation over the life of its asset. The learning objectives are apply the asset recognition criteria, understands which cost to capitalize for fixed assets, calculate the depreciation expense and account for it, and then calculate gains and losses when we dispose of an asset. Then look at how gross PP&E, net PP&E, and accumulated depreciation change over time. And then at the end, look at asset impairments. The content is, as usual, video, practice quizzes, and some reading. The total estimated time for completion is 2.2 hours. The third and final topic of Module 2 is liabilities. And this is the other side of the balance sheet where we look at liabilities and equity, right? So we'll start with liabilities. And liability is just something we owe to other people. And companies routinely use liabilities instead of paying cash. If you can not pay cash right away, then that's smart management of your cash, right? So that's what we do. We have all forms of liabilities that companies engage in order to finance its operations. These include accounts payable, which are amounts owed to vendors, bank loans, bonds, and accounting for liabilities will help you understand how liabilities are created, how they're valued, and how they inform the liquidity position of a firm. The learning objectives are to apply the liability recognition criteria, value the liabilities, differentiate between short-term and long-term liabilities, account for those with elements of short-term liabilities, and then understand bonds, the pricing and transactions at point of issuance, and then after issuance, and then at maturity. The content are, you guessed it, video, practice quizzes, and some reading. The total estimated time is 2.3 hours. And in this particular topic, the most complicated piece are bonds. So again, I know you're always paying attention, But when it gets to the bonds, pay particular attention because in my experience in teaching for over 20 years, bonds are among the most complicated topics that students confront in financial reporting. So watch out for that one. All right, are you ready for Module 2 for a balance sheet specifically for assets and liabilities? Hope so, because you're about to go down the road. Enjoy. Bye-bye.